at the right time.
Thanks for joining us on the special coverage of the RBI monetary policy. Rising inflation coupled with growth showing some signs of improvement has prompted overwhelming number of economists to predict a rate hike this time. But the final decision lies within the 6 wise men who've been huddled in a meeting in the last 3 days. We'll know in the next 15 minutes.
Yeah, it promised to be an interesting one, Harsha, because I think in the morning when we spoke to Manish Vadhavan as well, he was saying that never before, according to him as well in the recent past, has the decision been so close as it seems today, because there are probably equal arguments for and against a pause or a hike, as the case may be. And the markets are going into this very, very flat, be it the bond markets or the equity markets. No big presumptions, as our poll suggests, as the Bloomberg poll suggests, an overwhelming majority in favor of, or what if there's a surprise?
Let's ask that question to Sanjay Mathur, Chief Economist at ANZ, who joins us. Sanjay, thank you so much for joining in. What have you factored in? Given the fact where inflation is, there is a lobby that believes that inflation is peaking and therefore the RBI has to wait. There's another that believes that the time to hike is now. Where do you stand?
Yeah, we're certainly in the latter camp at this point in time. We do think that the RBI would be raising its policy rate by 25 basis points. Several of the risks they had pointed out last time seem to be materializing in terms of MSPs, in terms of the fiscal slippage, etc., oil prices in rupee terms. So we do think that the time is now, but from here on they can go into an extended pause. Okay.
Tanvee Gupta, Jain of UBS with us as well, as is R. Sivakumar of Axis Mutual Fund. Both of you, good afternoon. Thanks so much for taking the time out. Tanvee, I know there will be equal arguments for and against. One, which camp are you in? And if that is indeed the decision that the RBI does make, what's the impact on the markets, do you reckon?
Well, we are in the camp that there is a higher probability of a 25 basis point hike in today's policy. I think the market is only divided on the timing. Most of the market participants are expecting a 25 basis point rate hike in 2018. It's just about whether they do it in August or October. Well, I believe that RBI should not, or the MPC should not delay the rate tightening, because a rate hike, as and when we are delaying it, can lead to a risk of a steeper tightening later. And we can see on ground is that headline inflation already at 5%, even though the next 6 months the headline inflation will head lower. But eventually in the Jan to March quarter, where RBI is expecting 4.7% number for the second half of financial year 2019, we see a number above 5. So definitely inflation is going to surprise on an upside. Core inflationary pressures are quite high in the economy. We can see that the core inflation actually stood at 6.3% YOY for June, which means that the underlying inflationary pressures are pretty high no matter what the headline inflation is showing us. Rupee is at an all-time low. Current account deficit has already widened to 2.5% of GDP. And for the first time in 7 years, we are going to see a BOP deficit in FY19. Plus the risk of fiscal slippages, especially if you look at the state fiscal deficit data, which recently got announced, versus a deficit target of 2.7% of GDP, the states were actually for FY18 actually registered a fiscal deficit close to 3.1% of GDP. Plus on the center side, we do see that the risk of fiscal slippages, especially ahead of 2019 elections, are quite high. I mean, looking at all these factors, if RBI kind of delays rate hike cycle, I would be quite worried about the rising macro stability risk in the economy right now. It's not only about inflation, and anyway, the MSP price hike has already been announced, which could again put pressure on the food prices going forward. So I would say definitely if they have to react, they should come out and hike policy rates in August rather than delay it to October policy.
Okay. Let's also get in R. Sivakumar from Axis Mutual Fund. What do you reckon the markets are pricing in, Sivakumar? Do you think how would you expect yields to react if there is indeed a 25 basis point rate hike, as the market seems to be believing?
I think the market is kind of digested it. As always, when you have a policy announcement and if there is a rate hike, you might see an immediate sell-off. But my own expectation is that if not today, over the next couple of days, we should see these same levels roughly hold. So we've been in this close to 780 levels for some months now, in fact since let's say February, so which seems to suggest that the markets have already digested one hike and probably can comfortably digest another in terms of levels. What is really interesting is what this will probably do to short part of the curve, because as with many other parts of the world, we have also seen a significant flattening of the yield curve, which seems to suggest that the markets are increasingly looking at sort of policy risk in terms of too much tightening from global central banks, and will RBI follow that? So that's something we are waiting to see the impact more on whether the curve will get flattened even more.
What do you reckon is likely to happen? There is a view that the RBI, the Monetary Policy Committee, might hike rates, but the stance may continue to remain where it is. Would that be the case? And if there is a rate hike, would that logically mean the stance also becomes hawkish?
I would say yes. I think it is very difficult for RBI to put on a face and say 2 hikes back to back, and still the policy is neutral. And the sanctity of the word neutral has already been lost. We have had 1 rate hike, 1 rate cut last August. And of course, we had that reverse repo hike in April of last year. All of this under this garb of so-called neutral policy. So what does it mean anymore? And if RBI really does put in 2 hikes back to back, it's as good as saying they're on a rate hike path, and that's a signal of many more, another maybe 2 or 3 more hikes comfortably to come over the course of the next, let's say, 6 to 12 months.
Actually, Sanjay, that same question to you really. I mean, is it about time that the RBI change its stance as well from being neutral to the one of withdrawal of accommodation, if that's one term?
No, I think that, see, so far where we are is that they've been highlighting a number of risks. We should also remember that the last inflation reading was sort of below market expectations. The implication of a neutral policy is really that we are data dependent. And I think that when you have a situation where inflation is being determined or the outlook by a number of risks, I think what the RBI is trying to communicate is, let's see how they materialize. I mean, for example, take MSVs, for example. Now, I think we've all worked out, and estimates are it would add 0.3 to 0.7% to inflation. Where the issue really lies is that until the government specifies what sort of procurement policy is going to be in place, you really can't assign a tangible number to it. You can only estimate a range. So I think keeping all this in mind, they can afford to continue to emphasize neutral, i.e. that they remain data dependent. I think one thing, though, what we are looking for is what do they communicate in terms of the outlook for liquidity and what the stance on liquidity is. Because given the BOP, given the rise in currency in circulation, liquidity conditions are set to tighten. And that's going to be a challenge given that this year the government's borrowing program is backloaded.
Tanvee, is that exactly that question to you? What about liquidity? The RBI has been doing a sporadic OMOs over a period of time. Is that likely to continue? The public sector banks are back in the market. Does greater participation mean that you are anticipating more activity? What's your reading?
I agree. We do see liquidity getting tightened, but we at the same time do expect some 700 to 800 rupees billion of another OMO operations via the RBI in the second half of this financial year. So I believe that the pace of OMOs will pick up over the next few months, considering that the liquidity conditions and the BOP deficit as well as the credit offtake picking up kind of means that the tightness in liquidity needs to be kept closer to the neutral level. So definitely we do expect participation by the RBI or intervention by the RBI to ensure that the liquidity remains neutral and not tightened, which it looks very likely looking at the current circumstances.
Interesting. We haven't had too many bankers also talk in a worried tone about what will happen going ahead. I mean, if indeed the RBI does do a back-to-back hike as well. Just want to mark what the markets are up to. We'll do this, of course, closer to 2:30 as well. But just want to mark what the bond markets are up to and what the equity markets are doing. The Nifty Bank absolutely at the same levels that it was. So about 0.5% lower for the Nifty Bank. The Nifty and the Sensex not doing too much. And the 10-year yield intraday is now meandering in or around that 7.78, 7.79 mark. So no big deviation out there for the 10-year yield as well. Let's see what happens in about 7 minutes from now. We'll get to know about it. Siva, the easy argument this time around, yes, and I think as all of you have stated, is that there is a rate hike out there. If the RBI is indeed data dependent, and if the RBI's job primarily is to be inflation targeting, though I know Tanvee said that, while that's the main context, you've got to keep in mind other factors as well. But if inflation targeting is one point, I agree, I take on board the point that the core inflation is moving up, but by the time these rate hikes take effect, the core inflation as well is likely to show some bit of a downtick in the last quarter of the current calendar. Is that not some bit of reason for the RBI to maybe take a pause in its stance of being neutral and not doing a back-to-back hike and then indeed be data dependent?
I think first to start with, data dependent means we are looking at past data, given that data comes with a lag and data is always backward looking. You cannot be doing that if monetary policy operates with a lag and takes effect maybe 2, 3, 4 quarters down the road. So I think RBI needs to be a lot more clear about what is it that they are reacting to. Are they reacting to past data, or are they preempting or proactively acting basis their forecast? And as an inflation targeting central bank, they have to be a lot more forward looking than data dependent. Having said that, you're absolutely right. There is every chance that you may get some base effects and other factors which come into play and maybe moderate inflation a bit towards the end of the year. But all that doesn't matter. Really speaking, what RBI is concerned about is the stickiness which is getting introduced by the fact that you will get food inflation up next year thanks to MSP hikes this year. The increase in core inflation, and to the extent that's driven by the currency, is again likely to persist for some period of time. So what RBI needs to very strongly signal is their commitment to 4%. The more they allow inflation to deviate maybe into the 4.5–5% band, the more the signal that they're giving to the market is we are all right to walk away from that 4% mandate for inflation. And I don't think they really want to do that. So they would want to hike. In terms of timing, a couple of factors need to be kept in mind, because the current growth numbers look quite nice, largely because you're comparing yourself to a very low base, the demonetization and GST related base which was set up in late 2016 or late 2017. And now when we look at the year-on-year numbers, we are comparing ourselves to that low base, and therefore the growth numbers look a lot stronger. Maybe the same growth numbers may not hold if we go into the September quarter or December quarter, which means the RBI's window to hike right now is much stronger, because data supports that, and as you look forward, you may not get the kind of growth support to rate hikes by the end of this calendar year. So from that perspective also, the timing, it makes sense for RBI to put in a hike either now or in October.
Sanjay, would you agree that this is likely to be, if there is a rate hike, this would be the last for this calendar year? Because as Shiva points out, that growth supports it now and may not be for the rest of the year?
I would broadly agree with that. That I think that we get a hike now or in October. Chances are we get it today, and thereafter the RBI sort of goes on an extended pause and reviews, because I think it will get very difficult, base effects, etc., for them to justify one later on. So I think they can afford to wait and probably look at the situation starting from Q1 of calendar 2019 as to how the inflation trajectory turns up once again, and probably reconsider or sort of reassess their position at that point in time. So really, we do think that this is going to be the last for the year.
Well, interesting trends there. Tanvee, what else should one look out for? I mean, liquidity is one factor, and the RBI is definitely going to make some noise around it, if not in the initial statement, which I believe it will be, but in the press meet for sure. What else would you watch out for? Because as we started off this conversation saying that the tilt is heavily in balance or in favor of the RBI going out and making a hike, as you said, and then assessing the road ahead for the next 6 months or 5 months, as the case may be.
So I would believe that in the policy, first of all, I need to really see if the RBI actually revises the inflation forecast upwards, because the last policy, when they gave out the inflation trajectory, they said it won't include the MSP impact. So now we have the MSP price hike numbers already with us. So definitely one thing we need to look at, how much increase they are expecting, or are they increasing their CPI inflation forecast upwards. Second, as we have been discussing in this session, is secondly on the policy stance, whether they want to maintain the neutral stance or change the stance to hawkish. The idea is if they maintain the neutral policy stance, it basically means a very shallow rate hike cycle. So maybe one rate hike today policy and then an extended pause. However, if they change the stance to hawkish, it would imply that maybe one or two more rate hikes is there on the cards. So definitely on the policy stance is something I would like to keep a close watch on. And other than that, are they worried about the financial stability risk, which I have been highlighting? Be it on the fiscal situation, which they clearly highlighted when the state finances report came out. Do they make again a statement about that in today's policy? And second, on the financial stability and what is their take on the global trade uncertainty? Because eventually in the medium term, the global trade uncertainty could lead to disinflationary pressures, but in the short term, because of the depreciation pressure in the currency, the inflationary pressures could be much higher. So I think there are a lot of things to watch out in this policy. So let's hope that the RBI or the MPC are giving clear outlines on their thought process.
Less than a minute to go to the RBI rate decision to come out. Shiva, very quickly, what are you hoping to hear from the governor?
I think we need more clarity. The markets, especially bond markets, over the last few months, last year in fact, has been extremely volatile, both at the long end and the short end, largely because of what is perceived as flip-flops. Let's say, for example, from the February to the June policy, etc., February to April and then June policy, etc. So there's a lot of flip-flops, and the market really wants to see some clarity, some guidance. I think that's what I would be looking for from the. Most importantly, markets can adjust to higher rates, market can adjust to stance change, but I think markets don't want to see each policy different outcomes.
Repo rate by 25 basis points to 6.25%. This is exactly what was expected. It's also predicted inflation at 4.8% in the second half of fiscal 19. It says the rate increase is consistent with this neutral stance. So Neeraj, you've got both. You've got a 25 basis point rate hike in the reverse repo and has maintained its stance at neutral. I'm just going to get you one more. Expects inflation at 4.6% in the second quarter of fiscal 19, forecast inflation at 5% in the first quarter of fiscal 20.
Okay, so more or less in line with what expectations were. Harsha is right. Let's just look at the reactions. The bond yields, the intraday will come up on your screen. I'll also bring up the Nifty Bank. There is some bit of weakening out there on the Nifty Bank. To look at that spike on the yields, 4 or 5 basis points, I believe, from 7.79 to 7.83. So that's the movement there. Ira Dugal should be joining us any moment right now with the details of the policy as well. I think as all of us indicated, there is no change out there on the stance as well. Let's just see if the inflation assessment, Harsha, they pointed it out, 5% in the first quarter.
Yeah, 5% in the first quarter of fiscal 20, 4.6 in the second quarter of fiscal 19. I think that they're broadly expecting the inflation trajectory to remain from the earlier forecast. But first quarter of fiscal 20 is the one that they're talking about 5%. One more markets you want to take a look at where the markets are at this point. The Sensex has declined as well. More importantly, second half of fiscal 19, inflation is predicted at 4.8. I don't have a growth number as yet, but the headline is very clear. There's been a 25 basis point hike and the stance has pretty much been kept as neutral.
Well, initial thoughts from our experts while we just wait for Ida to come in. Tanvee, your quick thoughts. We've given out your basis. Your initial thoughts.
So exactly in line with expectations, I'm just curious that they have not so much changed this year FY19 CPI inflation forecast. So mostly they expect that the food prices or the food inflation impact because of MSP price hike would be felt in the first quarter of FY20. Because as per our estimate, even the last quarter of FY19 should be above 5% CPI headline inflation numbers. So yeah, so I think they are expecting a delayed impact of the MSP price hike. That's what it looks like from these statements, but mostly in line with our expectations.
Couple of headlines coming out. Crop prices and monsoon and GST to impact inflation. The RBI says India's output gap has virtually closed. GDP growth forecast at 7.5% in the first quarter of fiscal 20. I repeat, inflation forecast at 5% in the first quarter of fiscal 20 and 4.6% in the second quarter of fiscal 19. Interesting that they've chosen to be consistent with their neutral stance and a 25 basis point hike at the headline number. Sanjay, a quick reaction to what you've made of it?
Yes, I mean, I think, as Tanvee said, it's very much in line with expectations. But The one thing that what I felt was that, we've seen that global growth has now sort of peaked and things are slowing. So I would have thought that if they are going to extrapolate the numbers, it would have been somewhat softer going further. That obviously hasn't happened. So that to me is a bit of a surprise. Other than that, in terms of the policy stance, etc., it's bang on what is in terms of our expectations.
Ida is at the RBI meet. She'll have to go to the press conference. So let's go across to her first. Ida, what do you have for us?
All right, fairly predictable policy, both in terms of the numbers and the analysis. You already know there's a 25 basis point hike that has come in. It was voted for 5:1. 5 members voted in favor of the hike. 1 member, Ravindra Dholakia, voted against the hike. No major change in the stance. They say that the policy action is consistent with the neutral stance. They go on to talk about the upside risk to inflation. Some of them were already mentioned: oil prices, global financial market volatility, fiscal risks. And they've added to that list with the MSP hikes, and they have said that that would perhaps bring in an additional risk on inflation. They have not made any significant changes to their range of inflation. There's some tweaking here or there, but essentially they're expecting inflation to remain between 4.8% and 5% all the way through the second quarter, the second half of the current year, and then the first quarter of 2019-20. For that, they have given you an inflation forecast of 5%. The reason that Q1 forecast is important is because a lot of people were arguing that by the time this round of monetary policy action comes into the system, inflation would have come down because of a statistical base effect. So should the MPC actually add? So by giving you a Q1 FY20 forecast, they're telling you that even then you will be above the midpoint of 4% from the inflation target. On growth, actually sounding very sanguine again, talking about a pickup in investment activity, talking about robust demand conditions. In fact, they are pointing to corporate earnings, particularly FMCG earnings, to suggest that perhaps the rural demand conditions are not as bad as being made out in some quarters or some debates around agricultural policy. They have not changed their growth forecast as well. 7.4% is what the forecast is. So actually, both in language, in stance and in action, fairly predictable policy. Not much in terms of development measures. There's just one I will mention, which is important to take note of. They have allowed banks and NBFCs to co-originate loans for the priority sector. But that's essentially it. I'll give it back to you in the studio for analysis.
Thanks for that, Ida. And of course, we'll hear from the RBI governor in just moments from now. Sanjay, sorry, you were making a point. You were finishing your point. Now you have the synopsis of the policy as well that Ida laid out for us. Your initial thoughts?
Yeah, I think that, again, by and large in line with expectations, and of course they are not sort of, they're still quite hesitant to say that, inflation would come down to the midpoint, so, or below the midpoint. So I think that's a very fair assessment. Now, as I was saying, that the issue is really in terms of growth. That with the global economy slowing, and we've seen a number of indicators globally slow down outside of the United States, is that going to have a bearing on growth next year? The second is that investment could potentially improve, but to expect a full-blown investment cycle, I think it's still a little premature, given that the bank lending channel is still going to be sort of impacted by the NPL issue. It's not clear as to how deep and sanguine an investment cycle can be in the sort of next 1 or 2 years.
Shiva, your reaction to the policy statement and the inflation trajectory as well?
So not much by way of surprises, and I think RBI is quite right to probably mark up their inflation forecast for next year, June quarter. I think that's more a reflection of the MSP increases, which we know works with a fair amount of lag. So they are looking at that as the trigger for this rate increase, and I think otherwise on track. But I will reiterate that while the market reaction has been very muted, and we know that the 10-year has barely budged maybe 2 or 3 basis points since the policy announcement, I still feel that 2 back-to-back hikes, the RBI is not on neutral, and given the chance, they will probably want to hike a couple of more times over the next few months.
Let's get in one more voice. Gautam Sinha, Senior VP at Motilal Oswal Asset Management with us as well. Gautam, good having you. Thanks for joining in. How are you penciling in this stance? And, well, as all our guests are saying, 2 back-to-back hikes. And what does this mean for investing by and large and banks in particular?
I think this was largely factored in. So if you have seen the trajectory of bond yields over the last 1 year or so, and market expectations, this was completely factored in. Somewhere in stock prices also, it has been reflective. You know, we have seen some of the housing finance companies which are most sensitive to rates have derated quite significantly. So nothing surprising here, honestly. The key question to ask right now is what is the direction going ahead, right? We have seen a low base effect play out. Hence, we have seen a very high core CPI print last month. So the sense is that inflation, other things remaining the same, should have peaked out for the time being, and so should have the rate cycle, right? So we should not expect further rate hikes going forward, just premised on the inflation trajectory so far. Crude prices have also been a little benign after having rallied very sharply. Crude leads to a lot of imported inflation in India. The third thing is MSP hikes, which have come into the fore now. But there one has to remember that we have to see how much procurement actually happens, at the elevated prices. MSP is signaling price until the procurement activity really picks up. So one cannot be too gung-ho about that at this stage, and we'll have to wait and see. So as things stand today, looks like inflation trajectory and hence the yield trajectory has kind of peaked out for the time being.
Okay, done and dusted. The Reserve Bank of India has hiked, the MPC has hiked the interest rates by 25 basis points and maintained its neutral stance. Tanvee, one point in the policy that caught my eye. At 3 points, the policy statement points out that the underlying economy or the growth of the economy continues to be robust. One, they're talking about how on capacity utilization levels in manufacturing sector remains robust. Industrial production data continues to be robust. High frequency indicators also seem to suggest that the economy is chugging along quite well. Tie this in with a 7.5% forecast for fiscal 20. What do you make of the optimism that the RBI seems to have on the growth engines?
At this point in time, clearly the rural sector...
Well, I would say that in the first half of this financial...
This is Tanvee. Go ahead, Tanvee.
Oh, sorry.
Well, I would say in the I would say in the first half of this financial year, you would see the growth numbers on an upside. In fact, what RBI is highlighting is actually seen on ground that most of the high frequency data is actually picking up or showing modest signs of revival. So definitely the first 2 quarters of this year, you will see a very good GDP growth number. But the problem is most of the tight financial conditions, the higher oil prices, and the way the global growth seems to be worsening, all that will start to impact the second half GDP growth numbers. So I guess there are more downside to the RBI's forecast of 7.5% for FY19 GDP growth. I do see that they might revise the forecast sometime in the October policy, maybe not now. But yes, in the next 2 quarters, at least the data print which will be coming out, or at least another couple of months, at least the high frequency data will continue to improve, partly on account of favorable base effect as GST and demonetization impact fades away, and also some improvement on ground. But eventually, as you move towards the second half, the global factors will take a more center stage in all your growth numbers, and then I see more downside to the numbers.
Gautam, come in on that. I mean, conversations with corporate India seem to suggest that the confidence on growth as projected by the RBI in their statement, but as coming in from the earnings season thus far and conversations with corporate India is really very, very buoyant. What are you guys penciling in with regards to growth? Does it tie in with the confidence that the RBI has as well?
Yes, from an earnings growth perspective, definitely we are seeing uptick happening. And if you see across sectors, growth has been robust, consumption growth has been robust. Some pickup in investment activity is finally happening that the RBI has mentioned. On the export side, IT exports seems to be picking up pretty decently. Pharma also, we think, will through the course of the year start to pick up. So no complaints on the growth side vis-a-vis last year. But one has to remember that we have a very favorable base too, because there was GST, there was demon, there were disruptions in the economy 1 year back. So from that base, we have definitely come back. Remains to be seen how sustained this is. Yeah, capacity utilization data is something that we need to monitor more closely and see if it continues to improve from here. That should definitely keep the growth momentum alive. The challenges which have emerged are, of course, from higher crude price, hence higher inflation too, and global issues like the trade wars coming in. So there are some challenges on the horizon. So let's see how that pans out. But for now, the growth definitely is picking up. So this year we are penciling in something like 20% earnings growth at the universe level, the universe that we look at, which would largely be the top 200 companies, so which is a pretty decent growth, you know. So after having been very slow for a very long time, finally we are seeing widespread growth coming back in terms of earnings. Also, I think the key area to watch out for would be PSU and corporate banks, where the earnings is really depressed even now. The base is really depressed. So there could be a fillip, there could be a comeback of earnings, which would lift the overall earnings even more. So that's something to look forward to through the course of this year.
Interesting that. Let's take a look at how the 10-year benchmark is also performing after the rate hike decision. Let's take a look at where the 10-year is moving as well. Shiva, just one question. You know, we were talking about liquidity just a short while ago. The point that the RBI has made on liquidity, it says for the month of June, July, liquidity has been surplus mode. 140 billion has been absorbed for the month of June, about 107 billion in July under the LAF. Does it give an indication of how the RBI is likely to, work with OMOs going forward, Shiva?
No, I think this is just facts, and we continue to believe that RBI is operating with that so-called neutral liquidity target. That is to say, they should not allow liquidity to go very persistently either into surplus or deficit mode. And in the second half of this year, you have the usual corporate credit demand, which will be fighting with higher amount of central and state auctions. So this second half of this year is going to be very interesting to see how much OMOs RBI will do. Our markets working with an assumption that RBI will do about 1 to 1.5 lakh crores of OMO for the full year. I would not be surprised if that number is even larger than that. So I think because that's needed, given the outflows in currency and other liquidity factors, including the BOP negative. So I think we should see RBI step up its pace of OMO significantly from the second half of this year.
The governor about to start speaking. Sanjay, Mathur, just one quick thought. We might have to cut that, of course, when the RBI governor starts speaking. But your quick thoughts before he does that. Sorry, has he started speaking? Okay, let's cut across.
Good afternoon, everyone. Firstly, I would like to welcome Deputy Governor Mr. Jain. This is his first post-monetary policy press conference. In its assessment of current and evolving domestic and global macroeconomic and financial conditions, the Monetary Policy Committee observed that since its meeting in June, global growth has sustained pace, but it has become uneven. Risks to the outlook from volatile and elevated oil prices, mounting trade tensions, and tightening of financial conditions have increased. Inflation has edged up in several major advanced and emerging economies, driven by rising energy prices and the pass-through from respective currency volatility. Financial markets remain unsettled, and capital flows to emerging economies have declined, with their currencies depreciating against the firming US dollar. Instances of contagion have also occurred since April. On the domestic front, the Monetary Policy Committee took note of the rise in retail CPI inflation for the third consecutive month in June. Even though food inflation remained muted, other components recorded moderate to sharp price increases. Households reported an uptick in inflation expectations, while manufacturing and services firms indicated elevated input costs and wage growth in the organized sector remained firm. Even as inflation projections for Q2 have been revised marginally downwards vis-a-vis the June statement to 4.6%, projections for the second half of this fiscal year remain broadly unchanged at 4.8%, with risks evenly balanced. For the first time, the projection of inflation for Q1 for the next financial year, that is 2019-2020, has been given, and it is placed at 5%. Excluding the HRA impact, CPI inflation is projected at 4.4% in Q2 of this fiscal year, 4.7 to 4.8% in the second half of this fiscal year, and 5% in the first quarter of 2019-2020. In the view of the MPC, there are several risks to this outlook. The high volatility characterizing crude oil prices, financial turbulence in global financial markets, hardening of households' inflation expectations, and input pressures faced by corporations domestically. Moreover, any fiscal slippage at the center and/or state levels could have adverse implications for the inflation outlook and could crowd out private investment going forward. There is considerable uncertainty around the full impact of the MSP changes on inflation, which will only resolve in the next several months once the price support schemes are implemented and rolled out across the commodities. While the statistical impact of the HRA revision by state governments can be looked through, it is important to be watchful for any second-round impact on inflation. On the other hand, the MPC noted that the recent softening of commodity prices could contain input costs, while the reduction in GST rates could moderate inflation if there is a pass-through to retail consumers. In our assessment of the outlook for domestic economic activity, we observed that there is a gradual recovery of the southwest monsoon, but the sown area of Kharif crops is lagging in relation to a year ago. Industrial growth strengthened in April-May 2018, and the output of 8 core industries accelerated in June. Non-food credit by banks is growing at about 13%. Capacity utilization in the manufacturing sector remains robust, and there is optimism on the outlook. Services sector activity appears to be picking up in a broad-based manner. Double-digit import growth in May and June pushed up the trade deficit. Foreign direct investment flows improved significantly in the first 2 months of 2018-19, while recently foreign portfolio investment outflows have been slowing. Looking ahead, the committee felt that the progress of the monsoon and a sharper than the usual increase in MSPs of Kharif crops could boost rural demand by raising farmers' income. Investment activity remains broadly firm, and the pickup in foreign direct investment amidst buoyant domestic capital market conditions bodes well for prospects. Notwithstanding some tightening of financing conditions and rising trade tensions, GDP growth is projected at 7.4% for this fiscal year, as in the June statement. 7.5 to 7.6% in the first half of 2018-19, and 7.4% in the second half, with risks evenly balanced. The projection of GDP growth for the first quarter of 2019 is placed at 7.5%. In the assessment of the committee, uncertainty around domestic inflation needs to be carefully monitored in the coming months. In addition, rising trade protectionism, geopolitical tensions, and elevated oil prices pose grave risks to near-term and long-term global growth prospects by adversely impacting investment, disrupting global supply chains, and hampering productivity. Against this backdrop, the committee decided to increase the policy rate by 25 basis points while maintaining the neutral stance of monetary policy. The committee reiterated its commitment to achieving the medium-term target for headline inflation of 4% on a durable basis while supporting growth. I'll now request each of the deputy governors to say a few words. Dr. Acharya.
Thank you, Governor. Good afternoon, everyone. I'll start off by saying a few words on the inflation projections. The impact of MSP hike on the projections is a challenging task. What is known as of now is that the increase in MSP for Kharif crops is much larger than the average increase seen in the past few years. Now, such an increase operates through multiple channels in affecting inflation. There is a direct impact on the prices of the targeted food items. There could be relative price adjustments within the food baskets. There could be impact on rural wages. And then there could be generalization of all this through inflation expectations. It's important to note that a part of the announced MSP is already built into our baseline projections as of 2 months back, because that's the average increase you are seeing year after year. So it's only the incremental impact that needs to be factored in. So while there is considerable uncertainty, we have looked at all the available information and what we think is a reasonable estimate at present that we have factored into the food projection. Now, of course, as the implementation details become clearer, these projections will therefore will necessarily have to undergo some revision. Second, I want to stress that the monetary policy transmission operates at several quarters of lags. And as a result, the 2 rate hikes of June and this policy will play out only in due course in our immediate projections, because they will take some time to bite on the inflation. A few words on liquidity conditions. We had indicated at the last policy that we expect liquidity in the system to move into neutral zone in the first half of fiscal year 18. And consistent with this indication, on most days in June and July, the system liquidity has remained in neutral zone. There are, of course, modulations related to tax outflows and changes in government cash balances. The system, however, is still in a small surplus on average, and this is also reflected in the fact that the overnight lending rates and the weighted average call rate, which we monitor closely in determining our transient liquidity management, it has remained on an average 10 basis points below the policy rate during the June and July period, though it has come down from 14 basis points during April and May. Besides the transient liquidity management, RBI also conducted 3 OMO auctions of rupees 10,000 crores each so far in the fiscal year. Last point on liquidity, though the growth in currency in circulation has moderated to some extent recently, its expansion remains above historical trend. And as we have been telegraphing, reserve money growth is expected to pick up in the second half of fiscal year 18. It's usually coincident with the start of the festive season. RBI will continue to actively manage the system liquidity so as to achieve the monetary policy objective of aligning the overnight weighted average call rate with the policy rate while meeting economists' demand for reserve money growth. The evolving liquidity conditions will determine our choice of specific instruments for transient and durable liquidity management. Finally, just 2 quick words on the developmental and regulatory policies. We are proposing to undertake a review of the various foreign exchange derivative facilities for residents. It is meant to reduce administrative and documentation requirements and making the present set of regulations more principle-based in order to incentivize hedging transactions while disincentivizing sort of what might look like hedging transactions but are not. We are also hoping to encourage, as a part of the review, mechanisms through which Indian multinationals can hedge their global currency risks and in non-rupee cross-currency pairs out of their treasury operations in India. Second, With increased global integration of domestic markets, it is increasingly being discussed that market timings may be reviewed in order to facilitate better and quicker pricing of global developments. Of course, any changes to market timings have to be in sync with clearing and settlement arrangements and their efficiency. So it is proposed to set up an internal working group that will comprehensively review timings of various markets that are under the purview of the RBI and assess the necessary payment and settlement infrastructure that can support a coordinated timing across these markets. Thank you.
Mr. Vishwanathan.
Thank you, Governor. I want to draw attention to two policy announcements, and both this relate to cooperative banking this time. Firstly, we have decided to extend the access to MSF and to the scheduled urban cooperative banks, and LAF and MSF to the state cooperative banks. This will provide them additional tools to manage their liquidity and also broaden and deepen the financial markets, which will in turn facilitate better transmission of monetary policy to the money market rates. In fact, the list of eligible banks will be reviewed on an ongoing basis because there are eligibility conditions, and that will be announced on an ongoing basis by the concerned department, which is the Department of Cooperative Banking Regulation. The second, again, relates to cooperative banks. Currently, the urban cooperative banks were allowed to trade in the non-investment, non-SLR investments only with the commercial banks and the primary dealers. We want to provide them a larger revenue with whom they can trade, and we are therefore including mutual funds, insurance companies, pension funds, etc., so that they will have a wider choice of counterparties and enable them to get better price discovery for their non-SLR investments. That's what.
Mr. Kanungo.
Thank you, Governor. I'll talk about the GSEC market, one of the important announcement that is there in the Part B. As you know, over the several years, Reserve Bank has been consistently trying to widen and deepen the GSEC market. In line with these developments, RBI has been operating a state-of-the-art central electronic depository with SGL account and CSGL account in our public debt office in Reserve Bank for holding the securities of the market participants. Several market participants, they have been demanding and they have been requesting us to take a relook at this. As you know, the guidelines were last reviewed in the year 2012 and has not been reviewed since then. So in order to improve the operational leads and give them more flexibility, we are taking a relook at these guidelines. A comprehensive review will be undertaken. The kind of thing that they have been requesting is that whether the opening of the account or the closure of the account, does it necessarily require a no objection certificate from the respective regulatory department of Reserve Bank, even though they are number two, they have been demanding whether there can be multiple accounts. We allow only one account. So these kind of requests have been coming, and we'll take a look at this and review the guidelines comprehensively. And by October, we'll issue the guidelines. Thank you.
Mr. Jain.
Thank you, Governor. Let me touch upon two policy announcements in today's policy. One on the co-origination of loans by banks and for lending to priority sectors. In our continuous efforts to bring the financially excluded segment of the society into the formal financial sector and these priority sector lending, the co-origination model between banks and NBFCs have been conceived. This convergence between banks on one hand and the NBFCs on the other can bring the strength of the two sectors together. Accordingly, a framework for co-origination of loans by banks and the NBFC NDSI, non-deposit systemically important NBFCs, with risk participation is being introduced. While it would ensure skin in the game for both the parties, it would benefit the priority sector beneficiaries in terms of cost of credit, which on account of blending could be substantially lower. To begin with, the scheme will be allowed only to scheduled commercial banks, excluding RRBs and small finance banks, and NBFC NDSI on risk-sharing basis. We will issue basic principles to be adopted by both the institutions in their formal arrangements. The second policy announcement is with regard to strengthening internal ombudsman mechanism in banks. The internal ombudsman mechanism was set up with a view to strengthen the internal grievance redressal system of banks to minimize the need for the customers to approach other fora for redressal. As part of customer-centric approach, a review of the IUS mechanism was undertaken, and it has been decided to extend the IUS scheme to all scheduled commercial banks, excluding RRBs, with 10 or more banking outlets. Earlier, it was confined only to the scheduled commercial banks and few banks. The revised IUS scheme seeks to enhance the independence of the IUS and reinforce the oversight on the implementation of the IUS scheme for further improving the quality of customer service in banks. Keeping in view of rising customer base and the fast-paced growth of the digital transaction, the banks would have the option to appoint more than one internal ombudsman depending upon their assessment of the volume and nature of complaints. Thank you.
Thank you. We'll take a few questions. We'll start with Bloomberg Quint.
Thanks, Governor. Ira from Bloomberg Quint. Governor, we are now 2 rate hikes behind us. We also have inflation projections up to Q1 of FY20, which say that we will remain above the 4% mark. Against that backdrop, sir, can you explain a bit more about why a neutral stance is consistent right now or is appropriate right now?
Well, many of the risks that we have cited, which informed our projections, are on both sides, and that's why we have said that these projections are against the backdrop of balanced risks. Secondly, there is a fair bit of uncertainty around the CPI prints going forward, and therefore it was important that we kept our options open depending on the prints coming during the over the next few months, given the volatility of the prints that have, that seem to be coming most of the time. So that's why we emphasize that we would need to monitor the domestic inflation outlook in the coming months very carefully. For these 2 reasons, the stance is retained at neutral, and the risks around the projections are balanced. Thank you. Nikkei?
Thank you very much, Governor. Actually, I envy these numbers coming from Japan, where inflation rate is always de facto minus, and interest rates are always minus these days. Well, anyway, I wonder, in medium term, what is your diagnosis of cause of rising inflationary pressures, especially in the core inflation? And how does that diagnosis affect the judgment today?
I'll request Dr. Michael Patra to address that.
It's difficult to set out exact projections for the items in the core inflation for the medium term, but currently we have seen pressures getting generalized across services, particularly, especially health and education, and a large number of miscellaneous services which enter the basket of the common person. Thank you.
What is the cause of that?
There are several causes. Some of them are cost push, like Governor indicated, there are input costs feeding through. There are also some staff costs in the organized sector which are passing through. Also, there might be demand pressures starting up.
Economic Times.
Thank you. As the geopolitical risk uncertainty is looming large and trade war happening, so what is the possible outcome or fallout on the Indian economy, and how is RBI preparing to trade with that, given to maintain stability in the money and currency market?
We have already had a few months of turbulence behind us, and it looks like that this is likely to continue. For how long, I don't know. But the trade skirmishes evolved into tariff wars, and now we are possibly at the beginning of currency wars. Given this, we have to ensure that we run a tight ship on the risks that we control, to maximize the chances of ensuring macroeconomic stability and continuing with a growth profile of 7 to 7.5% going forward. We do have things that are in our favor, which you are aware of, and if we continue along that path, we ensure that we don't add to the global risk profile that would adversely affect us. Thank you.
Thank you. In India, we have 3 banks which are too big to fail. One of them is in the middle of a huge controversy following allegations of conflict of interest, among others. There are regulators like the SEBI and ACC are engaging with the bank. Is there any engagement from RBI also? And if there is a bigger issue of governance in the private sector banks?
Mr. Vishwanathan?
I think it's not appropriate for us to discuss any specific bank, but I must tell you that we are alive to what is happening in the banking system, and we are dealing with those situations as they are emerging. But I cannot mention what we are doing with a specific bank. As far as too big to fail is concerned, there's a global standards on that. We have issues like DSIP being identified, additional capital being maintained. All those principles they are adopting in India as well.
PTI?
Good afternoon, Governor. The policy gives a lot of reasons for what you did today, the hiking the rate. But at the same time, the risks are evenly balanced, even to the inflation. So what was the main drive for hiking the rate today? It leaves me confused. Is it the non-inflationary factors, especially the trade wars, or something else?
No, the main reason for changing the policy rate is to ensure that on a durable basis, we come to and maintain the 4% target. And we have been away from the 4% number for several months now. And we took 2 steps, one in June and once in August, to maximize our chances that we don't drift away from 4%, and in fact, we move towards 4% on a durable basis. So it's based on the objective that has been given, the data prints, and our projections going forward.
So we could possibly take one more question.
Thank you, Governor. Sir, even as our inflation is below 5%, but the core inflation is touching 6% or has crossed it already, may cross it already. So what is your fear around that core inflation part? How much is core inflation a concern for you, especially after, and add to it, this MSP has come, so it is already touching 6%.
You know, our mandate is to target the headline, and therefore, while we look at the components that make up the headline, our focus in terms of the policy choices is to get the headline to 4% or thereabouts. So while it gives us information, you know, it's not just core. There is core, and many others, as many as people want. The legislated target is on CPI headline, and our policy is oriented to keep that at 4%. Okay. Thank you.
Well, a short press conference, as it usually is. A lot of questions centered around, I think the 2 most important things that they probably could talk about is why is there a neutral stance, because of the 2 back-to-back highs, to which the governor has said that many of the risks cited are on both sides. And they mentioned that there are risks to the CPI prints over the course of the next few months, some of which may also impact the CPI inflation print on the downside. And therefore, they've kept the neutral stance so that they have the options open depending on what side the prints come in. I think that was one key question asked. And about the normal course of, I mean, why is it that they went ahead with the hike? Standard practice, I mean, I think it's a bit of a no-brainer out here. They've been away from this average that the RBI has wanted now for a while, which is the 4% mark. As Ida was saying in the press conference as well, the fact that the predictions for Q1 for the next year are also elevated seems to suggest that the RBI is worried of staying away from that mark of 4% for a while, and it's likely that the inflation numbers will look elevated until then. So might as well do a hike right now. So 2 back-to-back hikes, no change in the stance, seemed to suggest, don't quite know that as yet. I think Tanvee, Gupta, Jain will be better placed to answer, and then we'll get in a couple of other experts as well. I think seem to suggest that it's played as per script. 2 hikes back-to-back, the neutral stance stays, and arguably the action from the RBI going ahead, at least for the rest of the current calendar, would probably be a pause. An extended pause is probably a best guess. Before I get in Tanvee and get in some of the other guests as well, just to mark what's happening to the markets as well, the Nifty's moved back into the green. In between all of this RBI moves, I think there is some announcement on IDBI as well about the LIC IDBI deal. So IDBI as a stock has inched up a little bit in the session today. The Nifty Bank has crept up ever so marginally from where it was some time back, so about 0.5% higher. But this has turned out to be a non-event. The bond yields would have reacted, or the bond prices and bond yields therefore would have reacted dramatically if indeed there was a pause. That hasn't happened, but after shooting up a little bit, a bit of a pullback as well for the bond yield. 7.73 or 7.7390 I think is where the 10-year yield currently is. So, well, quite a bit of a pullback. I just want to clarify one thing, that all the beliefs about whether or not this is a move away from the neutral stance was clarified. I think the government kind of gave ample chat about that. Otherwise, par for the course policy. Let's get in some other voices as well while we just wait for Tanvee Shukla Jain to come in. Daljeet Singh Kohli, fund manager at Valentis, with us. Daljeet, what did you make of this, and what does it mean for banks? Yields have come off a little bit, but it seems like that after this action, there could be an extended pause.
Yeah, good afternoon, Neeraj. As regards with the market perspective, I think this was expected. So it was all in line with expectation, and therefore a kind of a non-event for the market in near term. And now the other important point is what happens to banks and what is their future going forward. I think this is for sure that now we are moving in that period where interest rates have to go up, and so that rally for all the financials or the banks and NBFCs, which was on this basis that cost of capital is going down, I think that's a thing of the past. So we have to be prepared for this now. How fast it will happen, or what will be the quantum jumps in the rates, that will depend upon many factors, and as and when we come across, that will be shown. But this is very clear that cost of capital is now going to go up, and therefore this equity market rally, which was kind of for last 1.5 years working on this thesis, so that has to also accommodate that. And therefore the returns also, expectation on equity returns have to be mellowed down probably.
Okay, now that's as far as the policy goes, and almost turning out from a market's perspective to a bit of a non-event, but for the fact that the bond yields have cooled off a little bit from the highs that they pointed. So 10 basis points off, but remember, yields are fickle in nature. A couple of policies ago at 7.10, dipped down to 7.15, and then had a run towards that 7.90 mark. So yields are as fickle as they can be. But let's talk about the markets. Last 15 minutes of trade left. Let's focus on that for a bit. As I said, LIC, IDBI, and IDBI, there's one stock that did very well. Multiple reports around that out. That aside, it's all exporters. Pharma and IT are the spaces that are looking good right now. PSU Bank as a space has done well, and Nifty Bank, after just pulling back a little bit, has again dropped about 193 or 200 odd points in the red. Ruchit Jain of Angel Broking with us. Ruchit, I want to trade on the Nifty Bank if you have one. Yesterday about 0.25% down, today 0.75% down. Is there more downside here?
Yeah, good afternoon, Neeraj. Neeraj, if you see today's activity, then I think in spite of this minor correction, the trend for the market has not changed. The broader markets, the market breadth continues to remain on the positive side. Yes, there has been a stock specific volatility, but that is mainly due to the event. Now, as far as Nifty Bank Index goes, 27,300 to 350 range is a very crucial support for the index. So I don't think that markets would, the Nifty Bank Index would go much below that level. So in case if we get some minor dip in tomorrow morning around 27,400 or 27,350, I think that should be a buying opportunity again in the index, and probably we should see higher levels around 28,000 very soon. So the trend for the markets have not changed. So this dip in the Nifty Bank Index, or if we get minor dip in Nifty, that should be used as a buying opportunity.
You have a Nifty strategy, I presume?
Yes, if you see broader markets, then today, irrespective of the event, the Nifty has traded in just a narrow range of 80 points. So there is no reversal pattern being formed. And on the higher side, the target projections for Nifty as per reciprocal retracement theory is coming around 11,430. So this momentum, I believe, that is likely to continue up to 11,430, which is about 90-100 points higher from current levels. So one can go long on Nifty itself. 11,300 to 11,270 is a crucial support. So below 11,270 stops should be placed, and target would be 11,430.
Okay. Some specific stocks which have corrected in today's session. Tata Global Beverages, top of the heap. The stock is down 5%. Remember, the revenues were up marginally, but the net profit was down about 6.6%. Margins came off a bit as well. And while the coffee segment revenue went up and the tea segment revenue inched up ever so marginally, there was an exceptional loss of 18 crores due to internal restructuring, and that put paid to hopes that people may have had. That sharp slide that you see downward was on account of those numbers. Daljeet, I'm using this as a crutch. I don't know if you individually have thoughts out here, but this whole QSR / consumption space, very, very chalk and cheese. While the likes of HUL, Dabur, etc., the numbers are good, the valuations are rich. On the other side, there are companies which continue to struggle. Tata Global, a case in point.
Yes, Neeraj, we have seen this big dichotomy, and that is the reason why when we see that the high-priced stocks are still moving much higher. Like one other example would be that Page Industry touching almost 30,000. Now, at every level, everybody would say this is very costly, but it has just been going up because they are showing numbers. So I think as in the last few months, we have seen that people have been only rewarding those stocks where the numbers are coming. We are not making any comment on the management quality or anything, but just that if the numbers are coming, then they are rewarded. And despite the fact that their traditional valuation parameters, they have just crossed much higher limits. So I think that this trend might continue for some more time, but to enter fresh at this point, we are also holding some of them, but we entered at much lower levels. So to enter new at this level probably is a bit fraught with risk, and too much of risk you are taking. But if you are holding, then obviously there is no reason to change that view.
No reason to change the view. Even on Tata Global, I can understand Page. I mean, it's a blockbuster company proving quarter after quarter why it is what it is. But even on a company like Tata Global, Daljeet?
No, we tend to not to speak on a specific company.
Okay.
So I would refrain giving any comment on that.
Okay, understandably so. Any thoughts on the oil marketing companies, Daljeet? After getting beaten down today, they were starting to look like they were strong. In fact, probably even right now staying fairly strong. Do you have a constructive view there?
No, unfortunately not. I believe that most of these times, 9 out of 10 times, oil marketing companies behave like a trading company. So they are dependent on what happens to their basic material, crude price. Now, nobody can judge what is going to be crude price tomorrow. So how do you take a call? If you have to take, I'm talking with the perspective of a fund manager or a portfolio manager. If you want to keep it in your portfolio, on what basis do you keep? How do you take a long-term view? We are holding stocks for 2-3 years, 5 years view. Now, how do you take a call on that? So there is no way you can do it. Probably these are good stocks for taking the small punts or for taking some trading bets in between, where you can see, okay, crude has come off too much, and so maybe 1 quarter of good results can be expected. At that time, you can take a call. But they are more towards trading bets, less towards investment. So I have, in all this past many years, refrained from taking them as an investment bet in my portfolio.
Understandable. Okay, 8 minutes left for the markets to shut shop. Ruchit, I'm first tempted to ask you about either your top strategies or maybe your top closing strategies.
From a positional perspective, I would recommend buying Glenmark Pharma. The weekly charts are quite attractive after a breakout from a falling wedge pattern. Prices have retested those breakout levels and again seem to have resumed its uptrend. So I think Glenmark Pharma one can buy at current levels with stop below 558 for target of 627. Well, this is for short term. And for a BTST perspective, Neeraj, I would recommend going long on Wipro. Although a bit of underperformance among the IT space has been seen, but no, the intraday charts are quite attractive, and inverted head and shoulders pattern could be in the formation from a short-term perspective. So just for BTST, one can go long on Wipro, keeping stop below 272 and expect target around 284 to 285 tomorrow.
Interesting. So BTST is on Wipro. Ruchit, can I ask you for a quick chart check on Page Industries, nudging the 30,000 mark and coming off as well ever so slightly? What does one do here? If say, for example, if somebody is long here, cash position, should he stay long? What do the chart suggest?
Certainly one of the outperformer, irrespective of what the mid caps have done in last 5-6 months. The trend still continues to be positive. So the best thing to ride such a trend is to keep on trailing your stop losses higher as the current market price goes on moving higher. And I think from a reciprocal retracement theory, the target projections for short to medium term are coming around 31,000 to 31,500. So keep trailing stop losses higher. 28,500 is the support now. So on any existing long positions, keep stop below 28,500 for target around 31,000 to 31,500.
Daljeet, are you constructive on the domestic commercial vehicle space? Ashok Leyland, for example, after the numbers has inched up 5%. Tata Motors, the quarterly numbers look bad, but the stock has inched up a little bit. The monthly dispatches would have looked okay. Ashok Leyland, by the numbers, I meant the monthly dispatch numbers, they seem to be okay. So after getting beaten down, Ashok Leyland is bouncing up as well. Are you constructive on this pocket?
Yes, I think domestic commercial vehicle industry is showing good signs. Numbers have been coming consistently for past few months, and this is likely to continue. But in our portfolio, our portfolio is more guided towards mid and small cap, less towards the larger ones. So we don't get too much of opportunity to play in these bigger stocks. Second thing is that we take a clue from this that if the CVs are doing well, then that means that overall economy is doing well, because CVs are a kind of an indicator or an early indicator of what's happening in the overall economy. So then that means you can play this through various other consumption stories, or you can play through the auto ancillaries, which are the guys who are supplying products to these companies, which fall into mid and small cap, our universe. So we try to play those kind of companies instead of going directly to CV players.
What about the gas companies, Daljeet? IGL doing reasonably okay the last few days. MBL, for example, after getting beaten down, has had a big run from those 800 levels all the way to 948. The numbers look solid too. What do you do with the gas distribution companies?
See, if we say theoretically, yes, this is the right thing, and gas is the preferred fuel now. So anywhere, anytime, if people would want to switch over from any other mode of fuel to gas, because it's much more cleaner, environment friendly, and now it's more efficient also. So one should be there, and there is a long trajectory for growth for these companies. Now the question is at what entry point you are entering, and secondly, how much flexibility do these companies have to actually improve their numbers. MGL, I'm particularly not very convinced about their capability to do that. I'm one of the users of them also. I know that I find that there is some problem with the company. They're not as efficient as they could be, and there is a huge potential there. So if some changes there or some thought process comes, obviously they can do much more. So volume growth which they are showing, I think, is much lesser than what is their potential to show. So therefore that means that as a investor it is a good thing to have that, because then you can see a long projection over there for next many years. The only challenging part is that most of them are public sector utilities, and there is not much of this management and eagerness to show good numbers or to come out with that. IGL has done much better than MGL over the period, but we are not holding any of these stocks.
Okay, Daljeet, we'll let you go on that note. Thanks so much for taking the time out and being with us, giving us your perspective. Really appreciate your time. Just final thoughts from Ruchit before we thank him. In fact, before we wrap up the markets and then take in closing thoughts. Ruchit, couple of stocks very quickly. Aditya Birla Fashion, like a phoenix, rises 10% today. Gati continues its merry ways, up about 8%. Is there a trade in either of these?
Aditya Birla Fashion already up by 10%, so the stop losses are too far to take a fresh trade. Gati, as we had discussed earlier also, that a breakout above 112 on a closing basis could start a fresh uptrend in this name. So I think yes, Gati can be bought at current level since it's indicating a close firmly above 112. Keep a stop below 102 and for target around 135.
It has lost almost 1%, Ruchit. You are not inclined to take any short position here, I presume.
Which stock, Neeraj, if you could come?
The Nifty Bank, Ruchit.
Yeah, no, I won't take a short position because the trend is not negative, and as such there are no signs of reversal. In fact, as I said that 27,300 to 350, this is the range where fresh long should be, one should look to again re-enter fresh long positions. So maybe tomorrow morning if we open a bit negative around 27,300 to 350 range, that should be used as a buying opportunity.
Okay, keep that in mind. Ruchit, stay on, we'll just take in final thoughts from you, but they need to close the markets. ICICI Bank, Maruti and HDFC, maybe throw in a Bharti Airtel. 4 key reasons why the Nifty has looked, or 4 key stocks which are putting the pressure on the index in the session today. Bring up those names: ICICI Bank, Maruti Suzuki, HDFC, HDFC Bank, Bharti Airtel. 5 stocks which are putting their pressure on the index in a big way. Hindalco too is down about 2.5%. What's defending the index today? Coal India 3.5%. Though I must say amongst heavyweights, not too many. TCS about 1.5%. And I wonder if the market cap of TCS and Reliance Industries have crossed again. We'll just try and check in moments from now. At the broader end of the spectrum, stocks which are doing reasonably well for themselves. Talwarkar Life up about 11%. Orient Refractories 9.5%. Excel Crop Care 6.5%. Nestle is up about 3.5% or 4%, almost nudging the 11,000 mark. Page Industries nudged the 30,000 mark. And Indiabulls Ventures up 1.5%. Avenue Supermarts continues to rise and shine, 1.18%, 1674, trading at the highs for itself. So good going really for some or all of these names in the session today. Just mark what's happening on the Nifty 500 and stocks we have gained and lost. So there is Tata Global Beverages, which has lost quite a bit. So that stock is down about 4.5%, 5%. Orient Cement is down about 6% in trade today. Reliance Infra is down. Raymond results impact down about 4%. Castrol about 3.5% as well. Rain Industries continues to drag lower, 4% lower in trade. Bank of Baroda, by the way, incidentally, is also down in trade. What's gained? AB Fashion, Navneet Education, good numbers there, 9% higher. Gati, 8% higher in trade. Trident, about 6% higher in trade. And Jagran Prakashan, again, results impact, up about 5%. IDBI Bank, the news effect, about 5.5% in trade. Final thoughts from Ruchit Jain as well. Ruchit, yesterday was wobbly, but today ITs looked fairly strong. Would you trade either the Nifty IT or any of the large components, TCS, for example?
There are 2 stocks that I think that could do well in short term from IT names. One is TCS, that as you said, and the other is Wipro. Wipro is indicating formation of a reversal inverted head and shoulders pattern on the daily chart. Definitely we are preempting that move, but I think the way volumes have panned out in last few trading sessions on declines, the volumes are very less. So we could see some up move in Wipro. And TCS, definitely the uptrend has been continued in today's trading session. Also, there is an up move which is indication of resumption of the uptrend. So these are the 2 names which I would prefer going long from the IT name. Apart from this, I think in near term, even couple of names from pharma that I would like to advise. One is Cipla and another is Glenmark Pharma. These 2 names are also, the weekly charts are quite attractive, and they are indicating that probability of a good up move in near term. So IT and pharma, this would be the space to watch out for short term.
Okay, Ruchit, I'm guessing you're broadly positive on the index because you mentioned buying the Nifty IT and Nifty Bank at lower levels if it starts off lower tomorrow. So we will watch out for that as well. But thank you so much for joining in today, Ruchit, and giving us your thoughts. Really appreciate your time. And viewers, thanks for tuning into this policy coverage and the market wrap. But of course, the complete market wrap with Agam Vakil coming up on the other side. Stay tuned to Bloomberg Live.